having a solid trading plan. This is the first thing we should do while we trade. We should have a plan, and the plan should have a clear and defined goal, which is how much we are willing to get and how much we are willing to risk. Of course, in each and every trade, we should specify entry, exit, and stop loss level, and we should stick to our plan and to avoid emotional decision. What this is trying to do is giving you questions and answer of situation you will face in the market, so you don't think about it when you face a trade. For example, if I told you today like to buy gold, for example, so when I say buy gold, if I'm doing this in my trading account, I wouldn't just go click buy. How much and when I will do it, and where is my stop loss, and where is my take profit, when I will go out of the market, when I will get in the market, and the risk should be defined even before I think about what I should buy or what I should sell. For example, if now Bank of Japan chairman entered from this door and said, whisper in my ear and said, Islam, the yen will go down, and then he leave, I will open a trade according to this advice, but I will risk only a certain amount, even if Bank of Japan chairman tell me this advice. Why I do so? Because this is in my plan. This is part of my plan. The plan should have a risk percentage per trade and risk percentage per account. So at least you will have this defined before you go to any trading. So we spoke about the fundamentals. Also, I will repeat this again for our new attendees who was not with us in the first session. We spoke about the economy. Any economy you are trying to trade, US dollar, gold, anything, this is an economy. So this economy has some decision makers who have some goals, and these goals will affect the economy to make it stable. And they want these three things. You hate me now, right? I'm repeating it. I will repeat it again because this is very important. Any economy want to achieve these three goals. Max employment, meaning the max number of people will get jobs. Stability, ensuring the economy is stable by controlling inflation. Inflation. I will repeat this word again. Why? This word is very important for any economy. Inflation simply means that when you go to get your cup of coffee, which used to cost you $2, it costs you $4. This simple increase in price is inflation. So this is very important for any economy. You want to control it, it will happen. It has to happen. It has to be increasing, but in a certain amount. For example, the Fed in the US has a target of 2% per year. 2%, meaning that this cup of coffee, if it costs you $2, it should cost you $2 plus 2% each year. This is the target. If it's 3% or 4% or 5%, they will try to do things. And these things they are trying to do will affect the dollar price. And if this happened from the Fed in the US, it also happened from the European Central Bank in Europe. It happened on Bank of Japan, on Bank of England. So when we trade bears. Even when we trade gold against the US dollar. Do you know that? When we see like today or before the weekend, the gold price closed on, for example, 2,614 or on 30, this is dollars. So the gold against the dollar, if there is any change in the economy in the US, this will affect the gold price. If the gold has some, of course, other major things to affect it but the US dollar affected more. So inflation and max employment and growing GDP, gross domestic production. This means that how much a country produced during a year. This is the GDP. It's good if it's growing and a certain amount of growing is the target of this economy. So max employment, inflation, GDP. This is the decision makers trying to achieve. When they try to achieve, they are not doing like you and me when we do a trade. When we do a trade, we try to win. We try to win. They don't try to win. They win. They achieve what they are trying to do because they are controlling everything. They control how much money in the system. Do you know that? The paper we have, which we call money, is a printed paper done by the central bank in each country. So this central bank has the power to make this paper less or more. Also, they can use the interest rate. Interest rate equals the price of money. So if the interest rate is going up, meaning the price of money is going up, making it harder to get money. Sometimes the price of money can be like zero, like in Japan. Bank of Japan used to have like zero or negative interest, meaning if you put your money on a bank in Japan, you will not get any interest. This used to be, they changed it to be like a quarter, and they are even trying to increase it. This decision affects the pair you are trading. For example, if you are trading the US dollar against the Japanese yen, you don't just ask your chart what to do. You have to know the fundamentals of the market. Okay, we will speak about technical, but fundamentals is very important. If, as we used to have, if we have two banks going in a different direction, meaning a bank like the Fed increasing the interest rate, and a bank like Bank of Japan giving zero interest rate. I'll give you a hint. Whenever there is interest rate going high, meaning this currency will go higher, because what you will do is you will take your money, go to this country, put your money to get higher interest rate, and you will never do this with this country who will not give you interest rate or even give you a take from you like negative like it used to be. So the dollar-yen pair based on these fundamentals. I'll repeat it for you. We have a dollar here and a yen here. The dollar giving you interest rate, and the yen is not giving you interest rate or a very less. So likely, the US dollar will go up. Raise your hand if you accept this. Raise your hand, please. Right? Right? You have other opinion? You have other opinion? Okay. So it will go higher. The Japanese yen will never go higher against the US dollar because of this equation we just say. So we have an uptrend for the dollar yen. And actually these currencies, they don't change places. So US dollar against the Japanese yen, they are not converted in the other way. We cannot have a Japanese yen against US dollar. So this is the trend, okay? When we have this trend, fundamentally, with fundamentals, we don't go then after that and say, I got this step, I got this technical analysis thing. We know there is a trend. We should follow this trend, okay? But as long as these facts are true, because sometimes it changes. Like for example, we had US dollar against Japanese yen going 460, meaning you pay 160 Japanese yen to get $1. Then suddenly we found it falling. Does this mean the trend changed? No, we didn't have the information. Then after that, we got the information. So this gives you something why the technicals, which we will speak about now, sometimes is faster than the fundamentals. But you have to have this fundamental knowledge. This is the targets for the economy: max employment, inflation reduced, and GDP growing. We have this, we call it the market cycle. This is what happened repeatedly, years after years. This is, for example, what happened in the 2020 pandemic. This is what happened in the 2008 crisis. It's always like this. There is a peak, there is a market going up, and during this phase, the jobs are available a lot, the GDP is growing, and the inflation is going down, everything is looking good. When we are here, we don't know we are in the peak, but we know the inflation start to go up and the jobs are starting to go down, the GDP start to go down. So they try to do something to avoid this, what happened during the contraction. So you try always to know where are you now in this cycle. If you are here, I give this example and I will repeat it again for our new attendees. In every market, I mean stock market, shares are being sold in this for some people. They call it what do they call this? They call it the smart money. The smart money, that's what they call. Because these people only know. Other people at this time, they say, tomorrow will never come. This is the end of it. It will happen now. No, nothing, it will crash. Actually, there has to be a good day after the bad day. There has to be. This is how life works. This is how economy works. So you always try to look, and if you are lucky enough, you will find a trade during this to buy, or you find a trade during this to sell. Have you seen the Big Short movie? Raise your hand if you know, if you saw it. The Big Short actually is a movie about people who benefit from the crisis that happened on the 2008 in the US. So actually this was bad thing for most of people, but for some people they made a lot of money. Just because they knew that we are here, not here, we are here. We are starting to fall. Because sometimes you have this idea, if we are in a very high place, then it should go down. No, it's not like this. You can be here and you think it's going down and continue to go up. And this can continue for months. You need to have an indication it's going down. And then you are with the smart money, here or here. Most of us trader trade here when it's too late already. So you should be having always knowledge of the fundamentals. It can be summarized only on this three things. This is only the fundamentals you need to know. Inflation, employment, GDP. Keep this in your mind. Always have a calendar. There is an economic calendar on our website on GODO CM that have all these events, and you should always follow the market to know where we are now. So we speak about the technical. This is the wizard part. This is where someone open a chart without knowing even what is this. We don't know what is this, right? It can be gold, it can be euro, it can be anything. We don't know. But technical analysis believe, and this is the third thing we are speaking about, believe that there is some patterns. This is from history studying that this is repeat itself. When we have this shoulder and head and shoulder, we have a market going up and then have this. You can see this actually before the crisis on the 2008. You can see this on the charts. So repeatedly, time after time, when we look at this pattern, we think that the market will go down after breaking this, what we call neckline. So the flag also have something to say, but for an uptrend, it's going up, consolidate for some time, and then break this level and go up again as long as this level was. These patterns, and also there is a lot of other patterns in technical analysis, based on one or three principles that Mr. Dow Jones made, which is like price discounts everything, that you don't need to know about the fundamentals, you only need to know about the price. The price discount everything. The whole story is here, and that the market goes in a trend, and the favorite part for everyone, history repeat itself. So based on that, you only need to look to the chart. So there is the fundamental team, there is the technical team. You shouldn't have this fight. You shouldn't be in one team. You should use both. For example, if I have a head and shoulders here, where the economy is giving me indication that everything is like on a peak, we are in very, very good condition, but then something started to happen. And you see here on head and shoulders. This is what? This is combined analysis. This is, you understand the fundamentals, which is the actual things that's happening, the jobs, the inflation rates, the GDP is starting to point. We are in a good position, but we are going down. And then you have something like this in the chart. So this is what you can do. What I'm telling you right now, you can easily find it in books. But what you cannot find is the bad things that happened to me or to one of my friends here. What we faced before, what we saw in the market, that we know that sometimes you sell here and you never see this price again. It goes up like to heaven. That can happen. So whatever your analysis is the fundamental or technical, or as I like, the combination of both, you should always have the risk warning in mind. I can lose everything. I should only trade with a certain risk management. And this is like some of the technical indicators we sometimes use. This is the Bollinger Bands. Raise your hand if you know what is Bollinger Bands. Okay. So this is for some of you, if you are not familiar with. If you see a chart like this, the chart, the price actually is this. This is what we call the Japanese candle. We call it because it's like a candle. This is the opening price. This is the closing price. This is green because it's going up. If it's red like this, means it's going down. So it's open from here and go down from here. And this wick is the lowest price that happened during the period of this candle, because this candle can be a day, can be a minute. So during this candle, this is the lowest price, and during this candle, this is what the highest price. After the finishing of the candle, it defines its up or down because it's the closing price. So if it's here, it will be a down red candle. So this is the trend of the gold against the US dollar, and this is the Bollinger Bands giving moving averages. The moving average, simply what it does is it calculates the closing price of this candle, the closing price, and divide it by a certain number. And this number you can change. For example, this is a daily candle. How many days, how many trading days do we have in the month? How many days do we have in the week? 5, okay. So we have how many weeks we have in a month? 4. So it's like how many days we trade on? 20, maybe 21, 22. So if it's 21, 22, some wise man might say, okay, I will use a 21 moving average because, as we calculated now, this is the number of days in a month. So now if I'm an up or down this moving average, I'm up or down of this average of the daily market. So the Bollinger Band suggests that if we are above this in the middle, we can buy, and below it, we can sell. This is a strategy. You can combine this also with the RSI, the Relative Strength Index. This just tell you how is the momentum of the market, how much people are buying or selling. We can actually imagine that this room we are in is like a market. So for example, I'm having gold, I'm selling to everyone. I'm the market, I'm selling to you. And 70% of the people are buying, or bought already the gold. So what logically will happen is, no more people to buy, less people to buy, and a lot of people to sell. So what will happen is the price will go down. This is the classical use of the RSI. But actually, what happened is, this is very important. I think I didn't mention this in the first session. I want you to look here. Where prices on the RSI, this is the 70%. At this time, the indication of this RSI telling that the market is already up for a very long time. See what happened. It continued going up, right? This is what I told you in the first session is, what I like to do is, it's giving me an indication here from 20 to 70. It's from 0 to 100, but this is 20 and 70, 30 and 70. If I'm above 50, I want to buy. The momentum is going up. You want to go with the tide, with the momentum. Okay, I give you a tip. Pretend that there is a very huge palace which has a lot of gold. Have some guards, and there is a very, very small door open for 1 minute. Will you go to this door and get some gold and go out during the minute? Everything will be fine. If you take more or stay more, it will be closed, okay? What you will do is, I think you will go get as much as you can during this time, as much as you can take and go out, right? Or the second option is you go there, you stay there, you fight everybody from the guards and take the palace. Raise your hand if you choose the first one. Okay? Use your hand if you choose the second one. No logical person would do this, right? Actually, when you trade, most of you do the second option. You want to go get all the money from the market. You want to go get all the gold move. You want to get it from here to here. You don't want to let any penny. Why? Because you think this is a big palace. Why I should leave anything? You should remember, this big palace has guards. This big palace is not openly for you. It has a very small window. And this window or this door is as much as your money can handle, as much as your capital can handle. When you buy gold, you only buy as much as you can afford, right? So you use leverage in the trading. Raise your hand if you don't know what leverage is. Please, if you don't know. Okay. Leverage means you get your money multiplied by a number in a purchasing power in the trading platform. Meaning, if you have a leverage of 100 and you have a $1,000 account, your money is $1,000. Your leverage is $100. You have a power to buy this 1,000 multiplied by 100, $100,000. This is the leverage. It's like I'm giving you a high-speed car. This is the leverage, okay? This leverage can turn this $1,000 into $2,000 in less than a minute. And it can also do the opposite. It can turn this $1,000 into nothing, even minus. This is the leverage, okay? So go back to this example I just gave you. If I'm giving you the power to buy more than your money can afford, you have two choices. The first choice is to risk everything in this one trade. If it's wrong, you are gone. The second choice is you only risk certain amount. Raise your hand if you risk the whole thing. Thank God. Raise your hand if you risk only some amount. Logically, this is what you should do, right? But what you do actually is the first one. Most of you. When I finish this session and you go home and you start trading, you will do the first. You will just risk everything in one trade. Don't do this, okay? Because nobody knows when the door will be closing on you, okay? So technical analysis has very, very helpful tools, just like what I told you. It's having this RSI, it's amazing, this Bollinger Band, but nothing guarantee you 100% that you win. You should always keep this in mind. So that's risk management. So now we spoke about 3 points. We spoke about the trading plan. We spoke about technical analysis and fundamental analysis. This is the 4th point, the risk management. Actually, I was talking about risk management in each and every point, and I will keep speaking about risk management in each and every point because this is the only thing that you can control in this market. You are in a market where there is a big player. There is the Fed in the US, there is Bank of Japan, Bank of England. You cannot control what's happening for the dollar or the gold or the oil or the Bitcoin, but you can control how much you risk in a trade. This is the only thing that it's in your hand. Every other thing I'm speaking about is I'm informing you what other players are doing. In the fundamentals, I told you the economy players, they are having to go this way. They want max employee, lower inflation, higher GDP. They want this. So you think how the other player move will be. It's like a game of chess. How they will move. This is you predict with the fundamentals. This is how you predict their move. The technicals, actually, I'll tell you the real secret of the technical analysis. Technical analysis gives you the information that someone knows, but you don't. I'll go back to this example of dollar yen going down. Yeah. Do you need me? We have to what? Oh, okay, I will. Okay, this is a lot of my time is already done. So maybe this will be more useful if I give people more time in other occasion. And just for your trouble today, only for those who came today and who already have an account with us, I will have a one-on-one coaching for each of you. But this only will be on a real accounts already opened with a certain amount. The risk management I just explained to you, you shouldn't be trading with an amount which is less than $5,000. This is what I think is. This is a business. This is not something you gamble in. If you have a $100 account, you can apply the same principles. But the outcome will be like this small. I will give you the $5,000 account number logic. The logic is you risk 2% per trade. You gain 2% per trade. You only trade 20 times per month. You win half of this, and you lose half of this. And then you will get, if it's a 1-to-1, 2% against 2%, you will get like mostly zero profit. If you get 2% to 4%, you will get almost 10% profit after 1 month. 10% profit from a $5,000 account will be what? How much? 500. For me, this is the minimum amount you will feel you got a profit. If you have a $1,000 account or a $100 account and you are happy with a 5% of this, how much the 5% of a $100 account? $5. If you are happy with $5, I'll be happy for you. Logically, from my experience, I got like this $5,000, 500 profit. This is the logical one. So you have to get this risk management in your amount. The trades, actually, I don't have so much time to speak about all of this. So you will just need to, I spoke already about leverage. I told you about it. This is also very important. I have to say this. We have 24 hours trading session. The market is live the whole time. That's because only the market is, when it's closing here, it's opening another place. So, but there is some time which is the best time to trade. The high liquidity comes on it. And this is, we call it the US session or the American session. This is at 5 p.m. Dubai time.